Hello and welcome. You're watching All About Your Company here on ET Now. I'm Harsh Saita, and this is a show where we try to get you a breakdown of a single listed company daily to get you to be smarter about your investing as well as about your specific investments. And that's the objective of this show. Today, we're going to focus in on a rate sensitive company. It's Aadhar Housing Finance, which we have picked today. The repo rate change is obviously likely to impact all housing financiers and in fact all NBFCs and banks. Hence, this is a very pertinent conversation on a day like this. Let's start off about the first piece I want to understand from Aadhar Housing. The first piece is the repo rate impact itself. How is that going to impact spreads? How is that going to impact the company in particular? And that will also give us happen. The second piece is with regard to loan growth, because if the rate cut is passed on, and it likely will, what will the impact of that be on loan growth? If loan growth picks up significantly across the system, beneficial for all lenders, and Aadhar Housing's commentary will largely determine that, at least for the purpose of this show. Third piece is with regard to the potential risk. 75% of Aadhar shareholding is currently owned by Blackstone. They have a fund life of 5 to 6 years technically on the funds that hold Aadhar. But at some point, they're going to have to take an exit. The stock has done very well for itself over the last 6 to 8 months. But now, what next? And if at all there's an exit, how is that transition likely going to be, is what I want to know. The fourth piece is with regard to asset quality, whether there's absolutely any concern, whether there is any fear, and how are new geographies doing and behaving, because they continue to grow and expand branches, and that leaves you open to a possible asset quality problem. How are they trying to plug that, is what I'd want to know. Project finance recoveries, well, they may be small, but they might be coming through, and therefore I'd want to know how material are those. How quickly does leverage go up? Now, mind you, this is a 45% capital adequacy company, so does not require equity for a fairly long bit of time. So they'll keep taking on debt on their balance sheet, and as they do that, leverage will start to go up from 2.5 times currently to 4 times is what the guidance seems to suggest. How quickly does it go up? How quickly do they take advantage of that leverage is also what I'd want to know, because ROA will come down as a result of that, and I'd want to know whether that happens. Last off, branches and OPEX. Outside of ROA, how is the branch growth getting penciled in, and how is OPEX going to play out over the next few years? Because currently cost to income is fairly controlled. So I'd want to know all of that on our show today, and we'll give you a perspective on all of that. But first off, as we always do, let's start about what the company does and what is it actually into. It's an NBFC lending in the housing finance space, incorporated in 2010, currently has operations, or rather has been running its operations since 2011, so 14 years since that they've been doing this. They focus in on low-income housing finance sector and affordable home financing. So all of that is what they focus on. 2 key verticals is what they focus on as well, and we'll come to that. But it provides housing finance solutions to low-income borrowers. That's the essence of it. Let's talk about the branches first off. They have around 137 urban branches, 474 rural branches, taking the total branch count at the end of Q2 to 611. We'll show you the journey. There you go. That's the journey of the branch as well. From 341 in FY22, they've grown fairly rapidly. In nearly 4 years, they've done nearly double the number of branches. That's 611. So that's a very healthy 20% CAGR in terms of branch count growth. Let's talk about where the branch distribution is coming from. And that's the distribution of the branches. They've got a fairly well-diversified portfolio. UP, Maharashtra, Gujarat, Tamil Nadu. So they've got the rural belt covered. They've got the western belt covered. They've also got south covered with Tamil Nadu. So you've got a good mix of branches across geographies. You can see Rajasthan, Madhya Pradesh, Telangana, and some of the other states, even a Karnataka and Andhra Pradesh part of that list. But let's now talk about the AUM distribution. They're currently sitting at an AUM of around 27,000 crore, and that's the distribution of the AUM. So you can see a fairly diversified distribution in terms of AUM as well. That reduces risk. Geographic risk is one of the key parameters in NBFC lending, which we have seen, which Aadhar Housing in particular seems to, in some form or shape, be able to insulate itself from. So you've got Maharashtra, Rajasthan, UP, Gujarat, Madhya Pradesh, Tamil Nadu, Telangana, Andhra Pradesh and Karnataka, all of those contributing a fairly diversified state presence as well as state AUM distribution. Let's talk about the product mix, which is also equally important. Home loans is around 73%, loan against properties is around 27%. So it's a fairly healthy balance. The loan to value ratio is around 60%. Again, very important. The loan to value ratio is nothing but the loan amount given against the value of the asset which is available to it. So for every 100 rupees of asset, they only have given 60 rupees of loans, which should obviously be positive from a recovery standpoint if things go south. So that also is an important metric that we track. But the average ticket size as well, it's around 11 lakhs odd in terms of average ticket size per customer. And that's how Aadhar Housing Finance shapes up with regard to its company. Now let's talk about the various parameters that we generally assess. Let's start off with the P&L account. And the net interest income, if you see, has gone up by a solid 26% on a YOY basis, on a 3-year CAGR basis. It's a fairly strong growth that you've seen on the NII account. Let's talk about operating profit as well. Very similar kind of texture where you've seen a 3-year CAGR growth of 26%. Your impairments or provisioning has not grown as quickly, so it's been fairly flat, which is a positive. And then you have profitability also, which has grown at a slightly faster clip as a result of that impairment leverage that it is gaining. H1 numbers also not looking all that bad. Fairly good set of growth numbers. Just disbursements maybe slightly not looking as strong. But nonetheless, you've got a decent set of numbers even for H1 coming through. Let's talk about the balance sheet now. Now you look at AUM growth, it's been nearly 20% on a YOY basis last 3 years. Guidance for AUM growth continues to be between the 18 to 20% range. That's something you want to keep in mind. Again, H1 growth you can see is not exactly the kind of clip that you would expect an Aadhar to grow at or the guidance to be at. So it's a fairly muted number. We'll assess as to how H2 plays out with regard to growth. But guidance not changed. Capital adequacy, we spoke about this point as well. 45% capital adequacy, no concerns there. They did a fundraise in FY25, which is an IPO which they did. And therefore, you saw that capital adequacy spike up back to that 44+%, and they've maintained it that way. Let's talk about operational metrics again. And what we're seeing is in terms of yields, fairly steady, just a shy below 14% across cycles. You're seeing spreads which have largely been, again, very, very steady in terms of the spreads. And the cost to income has been sub 38%, except in 1 year where it was 38.1%. Outside of that, you've seen a fairly steady cost to income. So they seem to operate a tight ship is what I'm trying to get to in terms of the operational metrics. That's my conclusion. The ROA number has inched up from 3.2%. It's gone up to 4.3%. This is also because of equity. Mind you, viewers, equity as a component of the disbursements that are being made is fairly large. As more debt is taken over to make those disbursements, interest payments will have to go for that debt. And therefore, you will likely see the ROA shrink as a result. So you want to keep that in mind. But for the moment, the guidance is 4 to 4.2% for FY26 ROA. So no concerns here either. Asset quality. Well, you've seen an inch up with regard to GNPA and NPA. This puzzles me. We'll wait and watch and we'll try to understand what are the kind of trends that are playing out on both of these. But for the moment, it's fairly controlled. There's no cause of concern per se. Let's talk about the return ratios. We spoke about ROA, we'll speak about ROE as well. And this is again a very, very important metric. Return on equity, your equity. And what you're seeing therefore is mid-teens to higher teens in terms of your ROE, which doesn't look bad at all. Q1, Q2 was slightly muted. Growth also didn't kick in. Maybe by the end of this year, you'll see that ROE trajectory also inch up for the full year, FY26. Shareholding pattern, 75% owned by Blackstone. We spoke about this. There's FI, DI participation as well. And then there's public, which holds around 10% odd. In terms of number of shareholders as well, it's a fairly steady number across the last 3 to 4 years that we've seen. And therefore, that's what we're seeing. Let's look at valuations now very quickly. In terms of the price to book, 1 year forward, it's trading at 2.4 times. The IPO happened at around 2.9 times. All right. And you have certain peers trading at around the 3 to 3.5 times mark. So it's cheaper than some of its peers, but we've given this a neutral because 2.4 times 2 is a fairly decent price to book value to have. So we've been slightly more conservative on the valuation front. Let's look at analyst recommendations. 13 analysts have a buy rating on this one. No holds, no sells. 25% upside is what they have on this one. What we'll do on the other side of this break is we will speak to Mr. Rishi Anand, who's the Managing Director and CEO of Aadhar Housing. Stay with us. We will be live with Rishi in just a couple of minutes. Welcome back. You're watching all about your company here on ET Now, and we've just analyzed the 8 metrics of Aadhar Housing. Let's quickly stack it up and let's show you how those look. And what really stands out in this graphic as we look at those 8 metrics, let's quickly pull them up, is that there is no thumbs down. There's no adverse metric here, and that's the key positive. On at least any of the fundamental factors, we're not seeing that. Now, in terms of, let's go across to Rishi Anand, who's joining us, the Managing Director, CEO of Aadhar Housing. Rishi, you come to us on a critical day, and thank you for that. The repo rate cut that's played out, 25 bips. Your sense with regard to what this does for you on Aadhar's book, does it mean that you pass on this entire 25 bips to your customers? I understand 75% of your book is floating and 25 is fixed, both on the liability as well as on the asset side. What happens next? Give us a sense. Is there a lead lag?
Good. First of all, very good afternoon, Harsh. And as always, it's a pleasure to be on your show. And thank you for the lovely introduction about the company that you gave. Yes, it is an interesting day to be on your show with the repo rate cut. And I would say, before I get into what happens to next is, the market was entirely divided into, 50% of us were saying it might happen, and 50% of us were saying it might not happen. And this time I was on the I was on the other side of the table and was not expecting it. So obviously it came as a pleasant surprise. And you're right, for 75% of our book, both on asset side and liability side, is floating in nature, which effectively means that whatever comes in has to go out to the consumer. But we'll have to also look at the other metric, which is how much of it, our liability, is linked to MCLR and how much is linked to repo. So as I stack it today, 74% of our liability is linked to MCLR and 26% is linked to repo, which effectively means that all that is related to repo, we get immediate benefits. Whatever is linked to MCLR, you get benefits depending on the reset date. So the reset date can be annualized, biannual, or quarterly, as the industry works. And as and when, and it takes a couple of quarters, I would say, for the benefit to creep in. The moment the benefit comes to us, the organization will operationally takes about a couple of months, and then the benefit is passed on to the consumer. So from here on, the moment benefit, and we've seen in the current financial year, in the current calendar year, including today's reduction, about 125 bips, the repo rate cut that has happened, as and when, and we've already started getting the benefits of it. The moment substantial benefit comes in, it's going to be passed on to the consumer. That's the logical next step.
Perfect. So therefore, spreads will shrink at first. Q3 will see a shrink in spreads. Is that the way one sees it? I know don't look at it QOQ, but yeah, give us a sense.
So today, for example, we work on a 5.8% spread, Harsh. The spread has two components, as you would say, the lending rate at the book level and the cost of fund. So if I pass on, let's say, just for an illustration, if I pass on 10 bips, I am getting a 10 bips benefit on my cost of fund. So there will be no real shrink in the spreads. And also the fact that pays out is 25% of my book is fixed in nature, where there is no pass on that happens.
Sure. And Rishi, loan growth, does it give you more? I know H1 was slightly softer for you. Traditionally, has it been that way or something different that you've seen this time in H1? Does the 18-20% loan growth guidance really get stronger in terms of a case? Are you able to go above 20% likely in FY26 given this repo rate cut as well?
So the way, Harsh, the way we look at it is, we generally talk about what is the growth on AUM. If you remember and recall our previous discussions, we've always guided, for the current financial year, we've guided 20 to 22% growth on AUM. And as we speak, H1 numbers stack at about 21% growth in AUM. Disbursements, we spoke about 18%, we've closed at about 16.5%. I think it is more to do with seasonality impact, heavy rains, etc., and no real threat on growth on the overall industry.
Sure. Point taken. With regard to Blackstone, that to some extent was an overhang, especially for your investors. That's been put to bed now. How long is the duration of the fund? If you can give us an indication, if you have that. I know that Blackstone is your shareholder and you will not have much visibility, but if you have that, it will give your investors a little bit of visibility on how long will this play out for, because it owns 75% of your company.
Right. You're right, Harsh. And it's now in public domain that, from Blackstone fund number 1, Aadhar moves to fund number 2. The overhang, you spoke about the overhang, we've already addressed this to all the investors. The overhang obviously moves on. The fund life, obviously, these are funds which are managed globally by Blackstone. We would not know what is the fund life, but, indicatively, close to 4 to 5 years of overhang should not be there in the market now.
Understood. That gives a lot of comfort, I guess. Give us a sense with regard to asset quality trends. Q1, Q2 saw creep up with regard to GNPA and NPA. You spoke about that being seasonal on your con call as well. What changes in Q1, Q2, and what is the kind of exit FY26 number one can expect, at least on the GNPA account, if you can give us an indication?
You're right, Harsh. This is more of a seasonality impact, and if you look at the history of Aadhar Housing Finance, and also the industry perspective, typically Q1, Q2, you see an inch up in GNPA numbers, and then multiple efforts, right, from regulatory efforts to legal efforts to field efforts, and it substantially drops in Q4. Last couple of years, we've been closing the year at about 1.1% GNPA numbers, and it gives me no reason to believe that we should not be closing at similar numbers as we go ahead. For us, the clear indication of the first point of impact or contact is increase in bounce rates. Our bounce rates have been stable state for the last 6 quarters, so it gives me no reason to believe that our GNPAs will not close at the indicated numbers.
Okay, Rishi, last question from my side. Branch OPEX and give us also an indication of how ROA evolves as you start to lever your balance sheet. That is another crucial piece. And we've spoken about this in the past. You've expressed confidence on a 4% ROA. Give us the sense, what are the levers available to you to clock that 4.2% ROA, even if you increase leverage within the Aadhar Housing fold?
So Harsh, yes, branch expansion will continue. The good part in the branch expansion is that we have multiple kinds of branches. We have low-cost model branches, and we have obviously the regular branches. And when we say we are going to be increasing our branch network by about 50 branches each year, 35 of those will come in the low-cost model. So when 35 of these branches come in the low-cost model, there will be no substantial increase in the OPEX as we go ahead. So obviously that's going to contribute. Productivity enhancements, productivity and efficiencies enhancement will continue to contribute to higher benefits. Yes, we've been at about 4.3 H1 ROA with the lever slowly increasing, and lever is not going to be increased over a period of time. It'll take a couple of years. Our belief is that we should be closing the year anywhere between 4.2 to 4.25% ROA. The ROEs today stand at about 16% plus. Couple of years down the line, the way we look at our business, 17.5 ROE with a 4.1, 4.2 ROA is a comfortable journey.
Perfect. Okay. And OPEX, is that the lever where you hold 4% ROA? Sorry, very quickly. Very quickly.
So yes, OPEX and efficiencies are going to play out.
Sure. Perfect. Okay. Thank you so much, Rishi. That's all the time we have, viewers, unfortunately. And, let's quickly stack up also the rating once before we exit this show. And viewers, thanks so much for watching. Also, we wish our studio director, Vishal Agarwal, a very, very happy birthday. Of course, it's a very special day, and he's not our studio director. He's our head of production, but he's directing this show. So thank you so much, and wishing you a very happy birthday, sir. We leave it at that on All About Your Company for today.